The 5 top stocks under $10. That's what we're talking about here today, guys. So many times in the comment section, people will ask me about stocks under $10. What are some interesting stocks that are $10 or less? So that's what we're going to go ahead and do today. If I was forced to make a portfolio of stocks that were under $10, what 5 stocks would I put in that portfolio? That was my mindset going into today's video. Like, if I was absolutely forced to buy stocks that were less than $10, what type of stocks would I buy? You got to understand something before we even get into these 5 stocks. First off, like, all investments have risk, right? But if you're investing in stocks that are less than $10, generally they're very speculative investments. Generally something went wrong there. For instance, it could have been like big mismanagement with the company, and that's why that stock just kept falling. Next thing you know, it's under $10. It could have been an over-leveraged company where they just took out flat out, too much debt on the balance sheet and things like that, right? It could just be an over-leveraged company. It could have competition hurting them bad, and that's why it has fallen to under a $10 level. Maybe there was just a competitive threat that came in and it's just hurt their business massively, right? And it could be they just went public too early. A lot of times I'll see it in the stock market. A company will go public way before they should have. They should have built the business out more and more in the private markets and then took it public when it was more ready to go public, right? So there are a lot of reasons why stocks can go under $10. So hope you guys enjoy this. By the way, today's video is sponsored by my private stock market membership group. If you want to get in there, that should be linked down there in the description, all right? All right, guys, the first stock under $10 that I would add in my portfolio is a stock named NIO. This one has fallen off a cliff, all right? It's down to about $7.70 now. This one has a market cap of about $7.9 billion on it as of right now, all right? Now, NIO, this one went public back in early October. It flew up that day to around the $11, $12 range. On that very day, I did a video about NIO stock explaining how risky that investment was at that time. It's still a very risky investment, but at that time, the company basically had no revenues coming in the door. It was like non-existent, and yet they had this valuation that at that time was like $12 billion, which was insane. It was one of those companies that honestly, they just went public way too early. Now, also, it is a Chinese company. You got to understand your ownership rights in Chinese companies are different than US-based companies, okay? So Chinese companies, you basically have to have faith that maybe you have ownership there, because basically you're buying stock into an entity that is off of the Cayman Islands, okay? So it's a very different, you basically have to have faith that you actually have ownership. It's very different than owning a US stock, all right? Now, for NIO's latest quarter, all right, NIO lost $1.51 per US share, all right? A massive loss for a company that's like a $7 stock, right? Sales rose to $214 million, which is a massive increase. NIO improved its operating margin to negative 191% from negative 4,000% in Q2. That means the company lost less money relative to its sales, all right? As far as more in depth with their numbers, NIO delivered 3,200 units in all-electric premium SUVs. The ES8, it produced 4,206 units. The ES8 takes on the Tesla Model X in China's hot market for luxury vehicles and especially electric vehicles. For the fourth quarter, NIO expects to deliver 6,700 to 7,000 vehicles, more than doubling Q3's. It forecasts revenue of $418 million to $436 million in Q4, which would roughly double from Q3. Wall Street had it expected around $377 million. The 4-year-old company expects to start delivering the smaller ES6 by the end of 2018. Investors in NIO include Tencent, Baidu, and JD.com. Tencent also has a small stake in Tesla, all right? If you notice, those are all Chinese companies that actually have investments in NIO. Rivals include Xiaopeng, which is an EV startup backed by Alibaba, and BYD, which is backed by Warren Buffett's Berkshire Hathaway. But NIO's IPO filing made it clear that they only see their real competition as Tesla in the Chinese premium EV market for now, okay? So with NIO, you got to understand this is a high risk, I would call it a very high risk stock. But it could also be a very high reward stock, okay? This would definitely fall into that category. Maybe the highest risk, but also maybe the highest reward out of anyone. If they are the #1 player in China in electric vehicles in a decade from now, this is a stock that could be 10 to 20 times the value it is today, okay? If they have a 20% or a 30% or a 40% market share in China, plus expanding around the world, like, this is a company that could grow dramatically. However, on the flip side, this company could go bankrupt within 12 to 24 months if they don't get more funding, because basically profits are nowhere in sight right now. This company has profits nowhere in sight. So this is a company that literally could be bankrupt in a year or two if they don't get more funding, because I'm just looking at the losses they're taking right now. And unless they somehow, work a miracle and somehow get profitable sometime soon, this is a company that literally could go bankrupt if they didn't get the funding or something like that. So very high risk, very high reward potential out there for NEO stock. We'll have to see how that one plays out. As far as stock number 2 in the portfolio, if I was forced to buy stocks that are under $10, I would add some General Electric, which right now is a $7.10 stock. Its market cap is down to about $61 billion now. Forward P down to 8. General Electric was one of the great American companies, all right? And then this company had a massive amount of mismanagement and a massive amount of over leverage. And that's how you got this stock to go from, it used to be like a $30 stock to a $7 stock now. It used to be a company that had a market cap of $300 billion, like one of the biggest companies in the world, to now having a $60 billion market cap. The business has, it was, like I said, it just was very mismanaged and it was very over leveraged. And, but now getting to a $7 range, maybe it starts to get a little more interesting. They have a couple businesses that are phenomenal businesses, all right? Now, as far as GE, the way I look at this one, okay, if I was forced to buy this stock, I would think to myself, well, one, they sold many businesses, so the upside is very limited. Maybe I could get a 2x on this if the turnaround happens over the next few years. They sold off so many of their businesses, right? They have a couple really good businesses left now at this point in time, which basically means that your upside is limited now in this stock because they don't have as many growth vectors going for the company, at least over the next 5 years. So as long as they turn the company around, the new CEO turns the company around, it definitely can be a stock that increases. Maybe you get a 2x on it, but as far as something like a NEO where you could get maybe a 10x, I don't see it realistic in GE. All right. The number 2 point I want to make in regards to GE is if a recession happened, that would be an absolute nightmare for GE. Specifically, if a recession happened in 2019. Right now, GE is in turnaround mode. This is not a time that GE could really handle a recession very well. Okay, as we know, especially if it was a bad recession, orders would dry up for a lot of their very expensive products they make, right? And that would not be good for GE. So this is 2019. GE cannot really have a recession. If the overall global economy went downhill in a massive way in 2019, that would be dramatically bad for GE. The GE really needs in 2019 for the economy to stay strong so they can kind of help kind of get this company turned around. All right. Number 3 point I want to make in regards to GE is there is high belief that the new CEO is going to turn this thing around, okay? So GE, like I said, has been very mismanaged over the past few years, but there's a massive amount of faith that the new CEO came in there, has done a phenomenal job in his past at other companies, and a lot of people believe he's going to turn it around there and make GE into a very successful company again there. So a lot of faith from Wall Street in that new CEO, a lot of belief there. The number 4 point I want to make is if he does, the company should be very profitable, should be a very, very profitable business. You can see that in the forward P. And the company should be much more nimble if he can make a success of this. The company should be much more ready to maybe acquire new businesses or start new businesses a few years from now, as long as they can get this turned around over the next year or two, get things back on the right direction, get this company making lots of profit again, get the investor base back because maybe they can start paying out decent dividends again or something like that. And then actually, paying off debt, finishing off that, and then maybe acquiring some businesses and going from there and building up GE into a nimble, profitable company again. So there's a lot of work to be done there at GE. That CEO has his work cut out for him simply. But that's a great brand. It's a great, well-known company. They got some great workers over there, but it's still a work in progress, all right? Stock number 3 under $10 is Switch. By the way, we're going to go lower and lower in price. I think the next 2 stocks are going to actually be under $5. But Switch is a data center company. So a pretty small market cap, about $1.7 billion. A stock right now is less than a $7 stock. And as far as Switch, I'm going to probably show you some pictures right now. They make these elaborate, massive data centers that have a ton of patents that go into and whatnot for keeping the properties cool and dry and all those type of things, and actually very, very secured. Really cool stuff. If you want to get a job there, you have to be buff or have tattoos, one of the two. And look at this picture of one of them. I think this was in Michigan. Like, look at this. They built basically a data center out of a pyramid. Like, it was sick, okay? Really cool stuff, all right? Really good branding for a business that's really, really boring. Really good branding there, okay? Now, as far as this company Switch goes, They're expected to continue to grow. So current year about 7.5% growth, but next year they're expected to get revenues back up into a double-digit growth again, which is where the company had grown for a long time. They just had kind of fallen off recently. So if they can do that, like this is a fast-growing company again, if they can get back to those double-digit rates. Now this one just went public at the very beginning of 2018. This one went public and it was like over $17 a share, and since then it's just been down and down and down and down and down again. Basically, they decided to go after a kind of a different business model. They see some of the competitive threats out there in the data center space, and they want to be more of a competitor there. They kind of realize how big the opportunity is there. But that pushes profitability down in the short term for a while. So they're trying to grow the business in some of these high growth vectors, but it's just going to hurt profitability in the short term. Wall Street doesn't like that, but it's one of those things. If Switch can do this properly and do this in a big way, like this company could be massively bigger from here. This could be a company that's worth 10 or 20 billion dollars someday, versus right now is worth 1.7 billion. But once again, there's risks that are involved with this stock. They got to actually pull off this plan and do it right. All right. Stock number 4 under $10 is a company named Zynga. So Zynga is a $3.71 stock. This one has a market cap of $3.2 billion on it right now. Zynga is a mobile gaming company, all right? Now, Zynga was a hot stock many, many years ago, back when it had the Farmville game, which was on Facebook and whatnot, and they had Mafia Wars and some of those games. It was a hot stock, and for the last several years, it's kind of been down here in this $2 to $4 range as far as the stock goes. But they do have some exciting stuff possibly coming. Now, first thing I look at when I look at Zynga, I love their balance sheet, okay? $236 million just sitting in cash, about $183 million short-term investments. So you add that up, that's over $400 million in cash and investments. And as far as debts go, zero on the debt. So I love a company that maybe has been going through some hardships, but has a great balance sheet, and Zynga definitely meets that criteria. If we look at the current year, they're expected to grow revenues at around 11.8%. So this is a pretty fast-growing company once again. Next year, expect to do around 12.8% revenue growth, which is very, very impressive from this company, all right? If we look at its latest quarterly earnings, they slightly missed on EPS, okay? And then if we look at revenues, it was also a very, very, very slight miss, okay? But it was a nice increase year over year, because last year they did around $213 million in revenue in the same quarter. This year around $248 million, so a big increase in revenue there, which is very nice. Now, the most exciting thing probably about Zynga, other than maybe the balance sheet, and in fact is this is a growing company once again, is the fact that they landed the Disney contract to do the Star Wars games, okay? This is massive, massive potential. Now, of course, we don't know if this is going to be a hit or a miss. Here's the deal. If this is a major hit, and this is a great Star Wars game, great franchises as far as in the mobile space are worth between $2 and $5 billion, okay? If you can come out with a hit game for mobile that has actually longevity, and it doesn't just go up the charts for like 1 week and fall back down, but it actually, is like a Candy Crush type game, or a Clash of Clans type game, or something like that, that is a great franchise that brings people in and people use it for years and years to come in the future. If they could launch a hit like that with one of these Star Wars games where it has all the branding in the world, right? If they could actually pull that off, we're looking at a franchise that could be worth easily $2 to $5 billion. Zynga right now is a market cap of $3 billion. So this is potential to maybe double the company, and also they should get the second game as well and the third game if there are successes. Okay, so basically here's the deal with Zynga. If they come out with a hit for the Disney game, okay, the Star Wars game, it's the thing that could double the company. If they don't, it might be stuck at a $3 to $4 stock for a long time to go into the future. Stock number 5 is a company named Limelight Networks, ticker symbol LLNW. This is a stock that is $2.46. This is the smallest of all the stocks, okay? A market cap of only $278 million, but it's profitable in this past year and expect to be profitable in the future year, which I love, okay? Trailing P of 20, forward P of 15 in this company. Limelight Networks basically has a lot to do with content delivery into the online and social spaces, and they help build big companies with that, big broadcasters and whatnot. If you want to read more through the company's description, you can pause it right there. Another company that has an amazing balance sheet on, I love it, okay? We're looking at about $21 million in cash, about 28 million in short-term investments, a teeny bit of long-term investments. So basically you add all that up, it's around 50 million. And then as far as the debts, another company that has no debts on it. I love that about these type of companies, all right? If it's a company that has no debt on the balance sheet and it's loaded with cash, I absolutely love that, all right? Now, if we look here, they are expected to grow EPS from about 11 cents to about 16 cents next year. And if we're looking here, we're expected at about 6.7% overall revenue growth in this current year. Next year, expected around 11% revenue growth next year. So a good growing company in a good growing space and a great balance sheet there. So anyways, I would love to hear your guys' opinion about any of these 5 stocks. If I was had to buy one of these stocks, which one do you think I should buy? I actually don't own anything speculative. My most speculative investment is probably Tesla, but now Tesla's profitable, so it's much less speculative. So if I had to buy one of those stocks, which one do you guys think I should buy? I would love to hear from you guys down there in that comment section. As always, if you own any of those stocks, let me know if you have more insight. And if you know any other better stocks that are under $10, share it in that comment section. We would love to read those comments, guys. If you have any stocks under $10 you think are great, share it down there. Thank you for watching and have a great day.